Hello everyone, and welcome to Bank Payday Lending Basics, a webinar presented by the Center for Responsible Lending. I'm Carol Hammerstein with the communications team at CRL, and I'll be your moderator today. Since 2002, CRL has worked to protect home ownership and family wealth by reforming abusive financial practices. We are happy to have a wide range of participants on this call today, including consumer advocates who specialize in high-cost credit, civic groups, military family advocates, socially responsible investment analysts, and faith leaders. We appreciate all of you being with us. Rachel Anderson of the Center for Responsible Lending will give the presentation. Rachel is in CRL's outreach department, working especially with faith and religious communities to stop predatory lending. Rebecca Bornay will join Rachel to answer your questions. Rebecca is a policy counsel at CRL who works primarily on small dollar loan issues like bank overdraft loans and payday lending reform at the federal level. Feel free to contact Rachel, Rebecca, or any of our staff for follow-up. And please join us on Facebook and Twitter. And now we are ready to begin Bank Payday Lending Basics. So let's get started with Rachel Anderson.
Thanks so much, Carol. This is Rachel Anderson, and I'd like to thank all of you who've taken time out of your day to listen to this call and for your interest in looking at the issue of banks making payday loans. As Carol said, our formal presentation will be brief, about a half hour, and then we'd like to take as much time as needed to answer your questions. And I should also say, feel free to type in your questions as we're going along, and we won't be able to see them, or you won't be able to see them, but we'll be able to answer those at the end. So in the past several years, we've seen a disturbing trend. Just like with overdraft fees a number of years ago, banks are setting their sights on significantly increasing their fee income by introducing an extremely predatory product. Now, banks aren't marketing this as a payday loan. We're talking about products marketed as direct deposit advances, checking account advances, or Access Now, which may sound like harmless terms, but unfortunately these products are anything but harmless. In fact, they have all the characteristics of the debt trap offered by storefront payday lenders. The Center for Responsible Lending feels that it's important to stop this product before it becomes widespread in the industry, and before it becomes a big new profit center for banks, and before it becomes something that drains millions of assets from account holders. So for the next half hour, we'll be talking about bank payday lending, and we'll cover the following. First, we'll talk about payday loans, thinking about storefront payday loans and how they create a debt trap. Then we'll look at how bank payday loans also create a debt trap. We'll look more closely at which banks are making these payday loans and where, what parts of the country, how to find borrowers who may be caught up with a bank payday loan, and then turn our attention to policy, how bank payday lending impacts the financial services landscape. And finally, we'll wrap up with some steps that we can take to eliminate this abusive product. So first, before turning our attention to bank payday lending, I'm going to take a few minutes and talk about storefront payday lending and how it works and how it creates a debt trap for borrowers. So as many of you know, we think of storefront payday loans as something that's marketed possibly in a strip mall. You'll see the signs for Easy Cash or Quick Cash or just payday loan. And to get a payday loan, a borrower writes a post-dated check to the payday lender for the amount of their loan, a couple $100 plus a fee. The borrower gets the cash immediately, and the lender agrees to wait until the client's next payday before cashing that check. And these days, rather than writing a check, many people give payday lenders access to their checking account directly by providing a routing and account number. On the borrower's next payday, the borrower is expected to repay the loan amount and finance charges in full. If they don't, the lender cashes the check or withdraws funds electronically from their account. With fees between $10 and $20 per 100 borrowed, the typical cost of a payday loan is over 400% annual percentage rate, or APR. If a borrower can't repay the loan and fees in full, they may end up taking out another loan to pay off the first. Or more commonly, the borrower repays the loan and fees, but finds that they don't have enough money to pay off other expenses and end up taking out another loan even before their next payday. That's the cycle of payday lending that you see in this slide right here. And in summary, what makes a payday loan an abusive product is a combination of high fees, a payment that is due in full on payday, essentially a balloon payment, and the fact that it's secured with a signed personal check or electronic access to the borrower's checking account, meaning that that lender has ability to repay themselves before any other bills are paid. It's not an accident that payday loans are a debt trap for millions of borrowers. Payday loans are designed to trap borrowers in debt. In a legitimate business, a repeat customer is a happy customer. For payday lenders, a repeat customer is a trapped customer. So now we're going to turn our attention to this development, bank payday lending, which is essentially another arrow in the quiver of predatory products. First of all, here's how bank payday lending works. These loans are available to customers who have a direct deposit for their paycheck, Social Security, or other benefits checks. That customer can apply for a line online or over the phone, sometimes at an ATM. When their next deposit hits their account, the bank takes the money off the top. So let me back up. Let's say you've requested a loan from the bank, around $500. That money appears in your account immediately. It's super easy and quick. Then when the next deposit hits their account, the bank takes its money off the top, the full amount of the loan plus the fee. This actually gives you an idea of how someone signs up for one of these loans right online as they're looking at their account, signed into the account looking at their balance. The typical loan fees are $10 per 100 borrowed, very similar to a payday loan. Now, what if for some reason your regular deposit doesn't come in, or it's not enough to cover the loan repayment? So as I said, these loans are repaid immediately out of your direct deposit, but if your direct deposit isn't enough to repay the loan, after 35 days, the bank starts repaying itself anyway, even if that repayment throws your account into an overdraft situation. So as you can see, this can become a very expensive loan through the fees plus overdrafts charged to the consumer. So how much does this cost? The research staff at Center for Responsible Lending in 2011 took a look at checking account data. They looked at a nationwide sample that was representative across geography, household income, and credit scores, and looked at those accounts where customers had used these bank payday loans or direct deposit advances. Here's what we found. The typical bank payday loan is outstanding for 10 days. That means that 10 days pass between the day that the borrower takes out the loan and the day the individual's next direct deposit hits the account and repays the bank. At a fee of $10 per 100 borrowed for a typical 10-day loan, that loan costs 365% annual percentage rate, or APR. We also found that despite this short 10-day term, the typical customer is in debt to the bank for over 175 days of the year. That's an average of 16 loans each year. Now, we think that fact is very important. It provides evidence that the same debt cycle that plagues payday borrowers occurs in bank payday lending as well. Individuals take out a loan for a single short-term expense, but the combination of high fees and balloon payment means that they cannot repay both the loan and their ongoing expenses, and they find themselves needing to take out another loan very soon after the first, ending up in debt for most of the year. Finally, another important finding from CRL's research is that a quarter of bank payday loan recipients are on Social Security. So let's take a look, kind of review, comparison of bank payday lending compared to storefront payday lending. First, a typical interest rate, 365% for a bank payday loan, 417% for a typical non-bank payday loan. Both loans are due in full on the borrower's next payday or when they next receive public benefits or Social Security. Both loans are effectively secured by access to the borrower's checking account, and in neither case does the lender look at the borrower's true ability to repay the loan. And for both payday loans and bank payday loans, it's the structure of the loan itself that creates a debt trap for borrowers, setting them up for indebtedness for over half the year. Now there's ample research that shows that payday loans cause borrowers serious financial harm. There's research demonstrating that payday borrowers are at greater risk for bounced check fees, credit card delinquency, unpaid medical bills, even bankruptcy. Bank payday loans pose the exact same risks to borrowers and can lead borrowers to close their accounts due to problems with default and overdraft. So we've just covered the how this product works, and we'll look a little bit more now at where it's being practiced and more about identifying people who may be affected by a bank payday loan. As I do that, I invite you to type in questions about the content that we've just discussed, how these bank payday loans are working and how they compare to storefront payday loans. So who's doing it? Currently, there are 4 large banks making payday loans: Fifth Third Bank, Regions Bank, U.S. Bank, and Wells Fargo. This map shows the footprint of bank payday lending. These are the places where Fifth Third, Regions, U.S. Bank, and Wells Fargo have a presence and are marketing direct deposit advances to their customers. Now, if you're working with financially distressed households and are worried that they may be caught up in a bank payday loan, here are some things that you can do to identify if a bank payday loan is part of their financial problem. Bank payday loans may very well be a hidden problem. There's no APR disclosure, so people may not be aware of the full cost. They're repaid through this automatic deduction from the direct deposit. And so as a result, people don't fall behind on this loan because the bank is repaying itself, but instead will experience other account shortfalls, even overdraft fees. So as you're investigating the story of someone who may have taken out a bank payday loan, first of all, ask for the name of the bank. Is it one of the 4 that we've discussed? And ask for it by name. Are they using a direct deposit advance product, for example? You can also take a look at their bank statement, and you'll see in the transaction history a record, something along the following. It may say advance fee payment for direct deposit advance or other kind of advance. You really may have to take some time to dig and understand the story behind this product. As you work with households, if people have stories of their experience with bank payday products, please share those stories with us. We're really eager to speak with these borrowers and interview them, help us understand what's going on, and help others understand how this product works and how it drains money from households. So now we're going to shift away from the details of the product more to the policy landscape. As we've seen this rise of bank payday lending, we see that it threatens not only bank customers with serious financial harm, but it also threatens to undermine hard-won consumer protections. Currently, 17 states and the District of Columbia effectively regulate the operation of storefront payday lenders through their state usury or small loan law. In 10 of these states, banks are extending bank payday loans. Essentially, banks are offering triple-digit interest loans, even when storefront payday lenders cannot. If you look at this map here, the starred states are ones with an effective usury or small loan cap, but face the incursion of payday lending from either Wells Fargo, Regions, Fifth Third, or U.S. Bank, or some combination of those. Bank payday loans also undermine protections that the federal government has put in place for military families. In 2006, Congress passed and President Bush signed a law that caps interest rates on payday loans to service members and their families, and that loan cap is 36%. So if we don't stop banks from making payday loans, we can expect a race to the bottom in which storefront payday lenders ask states or even the federal government to drop its usury protections so that they can compete with the bank down the block that's charging 300%. There are a lot of other reasons to stop banks from making payday loans, and so we'd like to talk a bit more about policy going forward, how we can do advocacy and policy going forward. We think it makes a lot of sense to eliminate this practice. First of all, there is the high cost and the extended time in debt. 175 days in debt at 365% is too much. And this cost is unjustified given that banks are not able to repay themselves, or are able to repay themselves immediately with a customer's next direct deposit. We expect this product to create an although it's marketed as an overdraft alternative, we expect it to increase rather than decrease overdraft problems. And down the road, increase the number of unbanked customers, and again, undermine state consumer protections and military consumer protections. We also think we're at a tipping point to address this problem. The number of banks involved in payday lending is growing. U.S. Bank, Fifth Third, and Regions have all begun offering payday loans within the past several years, with Regions introducing their product in 2011. And one window into the future growth of this product is the way that it's being marketed to banks as an income generator. We see that through the statements of the software consultant, Fiserv, which sells to banks the software that enables them to manage and promote this product. What Fiserv is promising to banks is that in several years, revenue from bank payday product will be greater than all other ancillary fee revenue combined. So they're promoting this as a fee increase product, as a fee generator. And to their investors, Fiserv is saying that they're getting a lot of interest from banks, that the pipeline for this product is strong, and have even signed several banks, several additional banks beyond the 4 that we've discussed today. So this product is really poised to grow. We're at a key opportunity point to address it. The number of banks offering payday loans is still relatively small, but it's poised to grow, and if we act now, we can address it while the problem is small enough that banks will be subject to appropriate regulatory and consumer pressure. So there's a couple things that we can do to reverse this trend towards bank payday lending. There are 2 main ways. One is public pressure, raising this problem with banks and convincing them to stop extending these loans. The second way is engaging banking regulators, asking them to put an end to this practice. This slide identifies the four banking regulators that have authority to address bank payday lending. The first 3, OCC, the Federal Reserve Board, and FDIC, based on bank charter, and finally the Consumer Financial Protection Bureau, which has authority to supervise financial institutions that have over $10 billion in assets, which includes all the banks we've discussed today. The CFPB has authority to issue regulations relative to consumer protection issues. And we think, actually just going back to regulator action, we think there's a real precedent for regulators to take action. In the 1990s, a number of storefront payday lenders partnered with banks in order to evade state interest rate caps on small loans. At that time, the federal regulators stepped in and stopped banks from engaging in these partnerships, indicating there was credit, reputational, and other risks raised by payday lending. In many ways, the same logic applies to this product. So there are a number of advocates and groups around the country who are already engaged in this issue and are drawing attention to it. There's a couple of things that are really important. First is raising awareness. So we're already seeing opinion pieces, both by newspapers and citizens, speaking out about this product and its threat to states' consumer protections and consumer welfare. There are grassroots groups who are generating comments to the key banking regulators. Additionally, advocates have explored moving their money out of banks that participate in payday lending or asking their state treasurers to do the same. Finally, we want to think about reaching out to regulators and reaching out to banks as well as an advocacy strategy. So we'd like your help. Here are 3 ways that we can work together to address bank payday lending. First of all, identify individuals who are harmed by bank payday lending. If you work directly with households who are facing financial distress, find out if they've gotten caught up in a bank payday loan. It can certainly help you help them, and as I said, tracking their stories helps us demonstrate who is harmed by this practice. Make sure you're looking and asking a lot of questions, especially about products that are marketed as checking account advances, as many people won't realize that they've gotten this relatively new and expensive type of credit. Second, join with us in sending a letter to the bank regulators. After this call, we'll be circulating a letter that is addressed to all 4 banking regulators, expressing concerns about this practice and asking them to end this practice. And we would invite and really value you and your organization's signature and participation in that letter. Finally, send us links to your work. If you have or are blogging about this issue, speaking with borrowers, engaged in public action in any way, share that with us, especially if there's a link to that activity on the web or images or stories. We're gathering those pieces all together through a web tool called Storify, and you'll get a link to that in the end, that helps us all to stay in touch and keep each other informed about the actions that we're taking. Even as you send us your stories, we will also keep you in touch with developments about bank payday lending that we're learning as they come up. And overall, we want to provide you with whatever resources you need to be active in this fight to get rid of this abusive bank product. So on this call, we've covered how payday loans in general create a debt trap, and how direct deposit advances reproduce the payday lending debt trap. We've also covered which banks are making payday loans across the nation, and identifying that banks are making payday loans even in states that have consumer protections. We talked about how you might identify someone that is caught up in a bank payday loan and a number of ways that we can work together to eliminate this abusive product. So at a time when American households are already reeling from loss of wealth suffered in the economic crisis and struggling to maintain and rebuild their assets, the last thing we need is another source of predatory debt, especially the kind of debt that we might expect from a payday lender but not from a bank. So let's not let banks make predatory payday lending business as usual for working Americans. Thank you so much for your attention, and we'll now be turning to opportunity for questions.
Let's start with a couple of general questions for Rebecca. Are you with us now, Rebecca?
Yes, hi. Yes, hi.
Hello. So First question for you. You've been involved in meetings with federal bank regulators on this issue. Can you tell us about what they have done so far and what they could be doing?
Sure. First, in terms of what they could be doing, all of the federal banking regulators can use their supervisory or enforcement authority to shut down the bank payday loan product altogether. If, for example, the regulators found that the cycle of debt that bank payday loans create amounts to an unfair or deceptive practice, or that bank payday lending and the legal and reputational risks that it poses to banks undermines bank safety and soundness. In addition, the Consumer Financial Protection Bureau can issue supervisory guidance or rules that would address some of the key features of bank payday loans that Rachel talked about that create the debt trap. In terms of what the regulators have done so far, they haven't yet taken strong action to stop payday lending by banks. The OCC, who's the primary regulator for national banks like Wells Fargo and U.S. Bank, they actually issued proposed guidance to its banks, to their banks during the summer of last year of 2011, addressing the product. But our view was that banks could essentially follow the letter of that guidance without having to change the fundamental problematic aspects of the product at all, and that other banks that aren't making payday loans yet may take that guidance as a sort of green light to go ahead and start making them. And so the OCC hasn't finalized that guidance yet, but we and a lot of other groups have urged the OCC to withdraw the proposal altogether out of concern that it would do more harm than good. The CFPB has clearly indicated an intention to pay attention to payday lending in general and to bank payday loans as well. And just a few weeks ago, they kind of formally announced they're kicking off their supervision of payday loans generally. And we were encouraged that they raised concern about some of the key problem aspects of the product, like what we call sustained use. So we're hopeful, particularly now that they have a director in place, that they'll use their full authorities to address the product.
Thank you, Rebecca. Here's another one for you about how bank payday lending interacts with overdraft. We are often asked this question, overdraft loans or abusive overdraft products. What can you tell us about how these two different but related products work together?
Sure. So overdraft fees, as many of you know, are charged when a customer's account lacks sufficient funds for a check or debit card purchase, but the bank pays the transaction anyway and charges a fee of about $35 per overdraft. And then, like with the bank payday loan, they repay themselves the loan amount and the fees in full from the next deposit. And those who pay the most in these fees are often charged hundreds of dollars in a single day. Providers of payday loans, whether non-bank payday lenders or banks, are sometimes quick to promote payday loans as an alternative to overdraft fees. But the studies have long shown, in the context of non-bank payday lending, that payday loans and the cycle of debt that they tend to generate only make customers more likely over time to overdraw their account and incur overdraft fees in addition to their payday loan costs. So likewise, with payday loans, with bank payday loans, those marketing the bank payday loan software that Rachel mentioned, like Fiserv, they're marketing it to banks. They promise that these loans are actually not a substitute for overdraft fees, but in a supplemental way for banks to get fees from their customers. And one of their flyers says, that these bank payday loans will result in little to no overdraft revenue cannibalization for the bank. So essentially, by making payday loans, banks are piling on to those customers who are already most struggling to keep their accounts out of the red, piling on not one but two forms of extremely high cost balloon repayment short-term credit.
Thanks, Rebecca. Let's ask a question of Rachel now. Rachel, you mentioned that some of the groups around the country who are working on this issue who have been focusing on abusive practices like payday lending and bank payday lending. Could you just share a few more examples of what organizations are doing that might spark some ideas for this group?
Sure. One organization is a national one, the National People's Action, and they have networks in a number of states around the country. When this summer the OCC announced that they would they would speak to this issue, the NPA organized basically a comment process through their members. So kind of through online and email, generated 4,000 comments to the OCC indicating that payday lending is harmful, and they think that bank payday lending is as well. So that's one example of, and these comments came from all over the country, states all over the country, and citizens all over the country. So that's one example of a large number of people already speaking out. I can also say that as we've been circulating a letter to regulators, and as I said, we'll circulate that to all of you who are on the call, we've had an enormous response, again, from all kinds of parts of the country and groups that range from financial counseling organizations to religious organizations to community development organizations and others, all signing on and saying that that payday lending is something that we don't want to see in our banks.
Thank you. Rebecca, I've got another one for you. How can banks do this in states that prohibit payday loans?
So banks will typically assert that they're not subject to state laws that would prohibit these loans if they were made by a storefront payday lender. And part of this relates to a pretty complex web of laws and regulations around federal preemption of state law in the banking arena. But there are certainly important roles for states to play here nonetheless. Regardless of federal preemption, banks cannot engage in certain activities like unfair and deceptive acts and practices no matter where they are. But preemption issues do make it all the more critical, I would say, that federal regulators step in and address the practices.
Great, thank you. Rachel, we have at least one participant who has seen these loans made to military families that she works with. What is CRL see going on with bank payday lending in the military?
So we do know that these 4 banks are have branches and are located on some military bases, and so the possibility and there's a high likelihood of members of the military getting caught up in a bank payday loan. As you probably know, storefront payday lending was such a big problem for the military and military families that the Department of Defense asked Congress to pass a 36% APR cap on payday loans, which they did, which Congress did in 2006. But the banks making payday loans can, at this point, get around the Military Lending Act because of their structure as open-end loans. So, and with the location of these banks on or near bases, there's a high risk of military families getting caught up in a bank payday loan. If you are working with military families and are working with them on their finances, I definitely encourage you to also dig deeper into situations where there are high overdraft fees and so forth, even if a payday loan doesn't seem to be the presenting problem. And again, after this this webinar, we'll send around a document that can help identify those problems, as well as a video that you can use to help identify what's going on with families.
Thanks, Rachel. Let me find our next question here. Rebecca, I believe this one would be for you. When a family defaults, are banks pursuing the consumer through legal actions?
Yeah, I would say that we really don't know that right now. It's all the more reason that it would be helpful to have more conversations with borrowers. It is worth noting probably that the customer is only going to default on a bank payday loan when their account has literally run dry pretty deep into the red for a significant period of time. So for any one bank payday loan, just like in the storefront payday context, it's very likely the bank's going to get repaid for that one loan. The problem is that over time, the customer's account balance will become deeper and deeper in the red. This is what we've seen in the overdraft context as well, and ultimately result in a checking account closure. And so presumably, however the banks are handling negative balances, account closures, due to negative balances, in general, they would also apply to the bank payday loan context. But we really haven't, engaged with specific borrowers on that yet.
Okay. Rebecca, this may be another one for you about the demographics of bank payday borrowers. Since many poor people don't have a bank account, is it the case that people getting these bank products are less poor?
So, this is similar to the storefront payday context once again, where you are dealing with a subset of consumers who do have checking accounts. We don't have specific demographic information on what borrowers are taking out bank payday loans. We've encouraged regulators repeatedly to obtain that data. But what we do expect is that of the subset of borrowers who have checking accounts, those with lower incomes are getting hit hardest. It's what we've long seen with repeated studies in the overdraft context, and we would expect the same in this context as well.
Thank you. We are getting quite a few questions, and I just want to let people know they can still send them in as we're proceeding. And if you have a question that was prompted by one of the answers that our panelists have given, feel free to enter that as well. And get another one here for Rachel. Rachel, is it correct that Wells Fargo and Regions are both involved but are not yet promoting this practice in the state of Alabama?
My understanding is that both banks are offering this product in the state of Alabama, and if you live in Alabama or bank there, I think the key would be to look at the particular names that the banks are using. So for Wells Fargo, it's a direct deposit advance, and for Regions, it's being marketed as Regions Ready Advance.
And this is Rebecca, and just to add, others may know this, or I think it might have been on one of the slides, but Regions is actually based in Birmingham, and it certainly does seem that they're making payday loans there.
Okay, the bank payday loans. Here's an interesting one about the cost to the bank of each bank payday loan. I'm not sure if we have that answer yet. But the questioner asked, it sounds like the whole bank payday process is largely automated. Is that correct? And how is that done? What is the actual cost to a bank of each loan?
Sure. So this is Rebecca. I'll try to answer that one. Again, that's another question that we don't know the answer to, but we have urged the regulators to include that in the data that they collect from banks. But all indications would be that this is a very low-cost product for banks to offer. The only kind of underwriting they do is to require that a customer has a direct deposit, which we already know is a very low-cost way for banks to obtain deposits, and it's very automated, obviously. And we also know, as I mentioned before, that the default rate for any particular loan is very low because the bank is first in line. And so we've long said that in the storefront payday context, the payday borrower has a sort of a super lien because they're holding the customer's blank check, or I'm sorry, they're holding the customer's signed post-dated check. It's similar in the bank payday context, except the bank has an even greater super lien. They are literally first. They can take the money before they credit you, credit it to you at all. And so what we would expect is that this product is largely pure profit. And that's also consistent with the way the software consultants are marketing it, which is they say things like it's extremely attractive from a profitability standpoint and things like that. And so it certainly seems like it's very low cost for the bank.
Rachel, I've got one for you. Are the banks do they own some of the payday storefronts in order to reach unbanked people? And of course, you need a checking account to get a payday loan, so I assume that means people who are not customers of their own banks. Do you have a sense of that going on?
Sure. Well, and let me back up and say, what we're talking about are these high-cost loans that are happening through two totally different venues. So one is the payday storefront, that kind of often freestanding or business that's in a strip mall that is just in the business of issuing payday loans, maybe a few other small services, but mainly issuing payday loans. Those are the payday storefronts. My apologies. And then the second location that we're looking at are just traditional banks, and those are the bank branches, or when you go online and have a checking account with a bank. And as those banks offer what they call direct deposit advances, what we're talking about is essentially them offering a product that's as expensive as a storefront payday loan. Now, and so that's kind of the two locations that we're talking about. I don't have a lot of, I can't really speak to the idea of banks owning storefront kind of payday loan shops. It does seem to be the case that, and this problem is one in both cases that affects people who have a banking account. So to get a storefront payday loan or a bank payday loan, you've got to have a banking account, checking account. And the problem is that because of the high cost of the loan and the high incidence of overdraft fees, there's a chance of that household who had a bank account to lose their bank account and become unbanked. So this is a problem about the danger of households becoming unbanked because of high cost and predatory products. And it could be that banks are offering this, at least they are saying that they're wanting to reach out or do different things, but we'd really rather see them reach unbanked people with responsible products and ones that help people save rather than drain money from their account.
Thanks, Rachel. Rebecca, are we seeing indications that more banks are getting into the practice of making bank payday loans?
So we've heard about one bank in Michigan, a smaller bank, who has purchased the Fiserv software presumably with plans to implement it and start offering the product. And we've heard rumblings of other banks who are exploring the possibility of offering the product. And so, and one other point is that Fiserv, again, in late 2011 in their investor calls, they announced that they had some significant, what they called mid-tier signings. So relatively large banks, it would seem, who have purchased, again, the bank payday software. So there are some indications that more banks are thinking about rolling this out or even planning to. At the same time, there has been some increased scrutiny in the last few weeks even, where CFPB has highlighted that these loans are essentially payday loans. And so we'd like to think that some regulatory pressure, increased awareness, increased discussion might stem some of those banks' efforts to roll out the product. But at this point, it really remains to be seen.
Thank you, Rebecca. Rachel, we're getting a couple of people are asking if we have recommendations for alternative products to payday loans that we would make to policymakers, banks, and other advocates.
So there are a number of less expensive ways to access money for a short-term situation. In some cases, a loan from family, friends, or even a relief organization is a better option. People should look into banks or credit unions that have lower cost responsible loans. And in some cases, a credit card advance is generally much cheaper than either a storefront payday loan or a bank payday loan.
Thank you. So we have just a few minutes, and I'm going to ask Rachel one last question about what organizations can do. We have offered several different actions, but what is the one most effective thing, Rachel, that you believe a community organization can do to help fight this this practice?
I really will encourage participants to think about three big actions. One is to, if you are in a situation where you're working with households, engage those households and identify if they're being hurt by a bank payday loan. Obviously, the work that you can do with them individually and being able to share their story is really important. And then there are kind of two big arenas that we feel this message has to reach. First is the regulators. So please sign on, have your organization sign on to the letter to regulators or send your own. And then third is the public. We're in the middle of a national conversation in many ways about the role of banks and what kind of their what responsible lending and banking looks like. And so that can be in the form of an op-ed or a letter to the editor to say, you know, it's not responsible for banks to make 300% loans. It's not responsible for banks to get into the payday lending business. So those are three things you can do: reaching out and working with borrowers, identifying their stories, reaching out to regulators, and speaking out publicly.
Thank you, Rachel. We're getting close to the end of the hour here, so I just wanted to assure you all again, if you have other questions, we would be very happy to respond with you personally, especially if you have a question that is sort of specific, particular to your organization or one angle of the issue. We will be very accessible. We will be in touch. You can reach out to any of us on the staff here, and we'll be happy to help you. And thank you so much for being here today and for being so engaged in this conversation, offering all these good questions. We are really happy you are here.